Barry Knapp with Ironside's Macroeconomics. It's Sunday evening, March 27th. S&Ps are down 7 handles. I haven't gotten a quote from the bond market yet. Bitcoin has rallied and overtaken its gained back all of its year losses. And most importantly, perhaps the U.S. is up 4-0 at halftime against Panama in an all-important World Cup qualifier, virtually guaranteeing them qualification for the World Cup next November. Sorry. Our note this week was titled Q2 Outlook, Policy versus Productivity. I'm going to keep these comments very brief, in large part because all of the free subscribers will be receiving the full note tomorrow morning, about an hour before you get this audio podcast version of the note. And the reason we do that roughly once a quarter or so, just to give you a real look at what the notes are about. The notes really are the marquee product. We'd love you to consider becoming a subscriber and having access to the full research library, the notes, our ongoing recommendations. So there were 4 to 5 sections to the note this week. The first one was titled The Liquidity Trickle Strikes. This was a bit of a summary of our outlook for the first quarter, how we thought we were going to have a pullback. We did get very much the Fed policy normalization related pullback we expected, and then pounded the table and suggested putting some money to work when it first happened, and again right before the Fed meeting. The second section of the note was a bit about economic dynamism and how the 60-40 model really didn't provide much protection, and how badly the bond market's really gotten rinsed recently. We then wrote about the Fed's inflation process. We attended virtually an economics club of New York event last week where Glenn Hubbard asked Larry Summers a series of questions. And we thought the framework that Summers created for how a new Keynesian would expect inflation to unfold, flowing from the labor market to consumer prices, we thought was a pretty good framework for thinking about what the Fed's reaction function is going to be like. We don't agree with the model, but nonetheless, this is likely how the Fed will behave. We wrote a little bit about our growth outlook, the mix of growth, and our productivity outlook. We wrote a bit about emerging markets. It's we've gotten a number of good questions, and it's the first time we've tried to write too much about emerging markets other than China specifically, which obviously we're quite bearish on, and then wrapped it all up with our views on sectors, stocks versus bonds, and the overall tactical market outlook for the next quarter or so. So, as I said, we did get the 10 to 12% correction we were looking for. We pounded the table and said that we wanted you to put money to work in late January when we went down to 4,200, and then again before the Fed meeting back in several weeks or so ago. That's all worked out. Where we differ from consensus currently is we have a more bullish economic outlook, and it really is born out of productivity. When the pandemic hit, we thought the pandemic was 2 things that the global financial crisis was not. It was an inflationary shock, not a deflationary shock. Well, time has proved us generally correct on that, though I'm sure there's still some transitory inflationists around. But we also thought it was a positive productivity shock. And Chairman Powell got asked about productivity in the National Association of Business Economists event last week, and started out by saying, well, we can't forecast productivity. It just happens. And then he was pressed a little bit. And he said, well, there is a good chance that we'll have pretty decent service sector productivity as businesses have learned to use automation to deliver services through the course of the pandemic. Well, yeah, absolutely. That's correct. So we think all 3 main inputs to productivity are going to really be firing in 2022, and it's going to become increasingly evident in the next couple of quarters that that's the case. That's capital spending or capital deepening. That's labor productivity, labor dynamism and turnover, and then that's technology adoption for consumer goods, services, healthcare, in the industrial sector. We're going to really see that process accelerate, and that's going to cause profit margins to hold up better than most expect. There's a couple of notable equity strategists out there that think that earnings could be down year on year. We strongly disagree with that because of productivity. So we have a more optimistic growth outlook than most right now. And our inflation, hawkish inflation and Fed outlook we've essentially been caught up to by most of the other economists and strategists out there. So we're no longer on the real hawkish side of that. I think our growth outlook is really what stands out at this point. So moving on to this inflation process that Summers was talking about, and Powell has talked about similar things. I think it was the September FOMC meeting. He talked about unit labor costs driving inflation expectations. Well, Summers' simplified model for inflation was wage growth, less productivity equals consumer prices. So he likes the Atlanta Fed wage tracker, just as we do. That's running at 6.5%. He thinks trend productivity is 1.5%. We think it's stronger than that. Either way, that gives you 5% trend consumer prices. He thought that getting the unemployment rate up to even 4.5% would not be sufficient to slow wage growth and prevent consumer prices from running well above the Fed's target. And that's likely why the Fed will probably raise 50 in May and may very well, as Powell's made a soft commitment to, start the balance sheet contraction. So this is a roundabout way of saying we think the wage numbers are even more important than the consumer price numbers because of how the Fed thinks this process unfolds. So the employment cost index, which will come right before the next Fed meeting, this Friday's payroll report is a very big deal for whether the Fed goes, quickens the pace, which it seems likely they're going to do. So that's obviously a bit of a hurdle for the markets to overcome over the next quarter or so, notwithstanding the fact that we've already had that appropriate adjustment for Fed policy normalization. So moving on to the mixed matters and our growth outlook, we do think we're going to get more investment and less consumption. A lot of economists and strategists are looking for less goods consumption and more services consumption. That may very well be true on the margin because of pandemic restrictions. But recall the two biggest areas of consumption, either housing related or autos, we've been running below core demand because of supply constraints. So that process is going to unfold a little slower than most expect. I've heard some speculate we could have more of a permanently strong demand for goods because of work from home and changes in behavior. We'll leave that one aside, but we do think investment's going to be strong, and that's really good news for the equity part of the capital structure, for equities, and for our productivity outlook. So on emerging markets, we created a valuation matrix, which looks very much like our sector matrix, using a broad range of metrics. We don't have a ton of confidence in the data, which we got from Bloomberg, but it did essentially come out much as we expected it to do. So some of the cheapest region of EM looks to be both Europe and South America, with Asia being relatively expensive. That kind of fits our broad view. We don't like Asian emerging markets because we do think they're generally very export sensitive. We think there's going to be a significant export slowdown, and then we're already in a deglobalization era. So those regions, which are the richest of the emerging markets, are also the ones we think with the most flawed business models. Much of Latin America is actually commodity, benefits from higher commodity prices, and those markets generally look fairly cheap. So that's where we would add some incremental exposure. We're not willing to go all in on those markets, but those look relatively attractive. Europe is cheap for good reason. That's quite a bit more speculative. We're probably not ready to add exposure there. So wrapping all this up into our broad second quarter outlook, we got the sell-off from 4,800 to 4,100. It looked very much like we expected a Fed policy normalization related correction to look like. We're now at 4,500, so the risk reward isn't quite as good. But if we follow a typical Fed normalization related pattern, we will probably end the second quarter closer to 4,800. We do not think the bull market associated with the economic expansion will likely resume until the fourth quarter. So we'll have difficult times between now and probably the fall before we get into an extended uptrend. But nonetheless, we still think the markets are fine here, in large part because of our view on productivity and growth. Valuation matters once you get through the Fed normalization cycle. We still don't like fixed income stocks, at least relative to the real rates, still look relatively expensive. We could argue that the real rate part of the equation is incredibly expensive still, even with the big move higher in real rates through the course of the quarter from negative 110 basis points to negative 50. Those should still be positive. The technology and technology related sectors, which means consumer discretionary communication services, still look rich. We think they need another quarter or two of what are likely to be good earnings before the risk reward looks better for those sectors. Cyclical sectors generally look attractive, with the exception of industrials that look somewhat rich, but we still think they have room for further cyclical recovery in profit margins and earnings. Defensive sectors do not look cheap. They actually look rich, and we wouldn't touch them, with the exception of healthcare, which sometimes is considered cyclical, sometimes defensive. That sector we do like because we think it's going to be a big beneficiary of technology adoption over the course of the business cycle. So that's it for me this week. Have a good week, everyone. We'll probably get out a note to our full subscribers previewing the payroll report a little bit later this week, because we are getting the JOLT survey on Tuesday. That'll give us a real good look at labor market slack before we get that March payroll report. Barry Knapp, Ironsides Macro. If you're not already a subscriber, please consider becoming one. As I said, you're going to get a look at the full Outlook note as a free subscriber. Please have a look and consider becoming a subscriber. Thank you.